A number can become dangerous when people mistake it for truth. That is one of the first principles I learned from studying economies, markets, and human behavior. A number can sound precise, it can be printed in a study, it can move through the media, it can scare millions of people. But if it is not connected to a clear process, it is not a plan, it is a feeling dressed up as math. Right now, the number frightening many Americans is $1.46 million. That is the amount many people now believe they need in order to retire comfortably. It sounds official, it sounds as if someone went into a room, studied every household, calculated every future cost, modeled every retirement, and came back with the exact answer. But that is not what happened. What happened is much simpler and much more human. People were asked how much they think they need to retire comfortably, and the average answer came back at $1.46 million. It was higher than the year before. It was large enough to create anxiety, and almost half of Americans said they do not believe they will ever be financially prepared for retirement. That is not just a financial statistic. That is a psychological signal. When a society begins to believe that ordinary retirement requires a number that most households feel they can never reach, people do one of two harmful things. Some give up, others panic. Neither reaction is useful. Neither reaction is based on principles. I have spent much of my life trying to understand how systems work. Economies are systems, markets are systems, debt cycles are systems. Retirement is also a system. If you understand the inputs and the mechanics, you do not need to be controlled by headlines. You can break the problem down into parts. That is what I want to do here. I do not want to tell you that retirement is easy. It is not easy. I do not want to tell you that people should save less. Most people should save and invest more, not less. But there is a very big difference between a retirement number created by math and a retirement number created by fear. Fear creates paralysis. Math creates a plan. The $1.46 million number is a good example of how fear operates. It takes real problems like inflation, rising housing costs, healthcare uncertainty, and longer lifespans, and then turns them into one frightening target. The target feels safe because it is large, but large is not the same as correct. When people see inflation headlines every day, their minds overweight the danger that is most available to them. In psychology, this is called availability bias. The things you hear most often feel most probable and most severe. If every financial headline says costs are rising, your brain does not calmly calculate a retirement budget. It says, I need a lot. I need more than I thought. I may never have enough. That is not irrational in an emotional sense. People are reacting to the world they are living in, but it is not a reliable way to make a life plan. A good plan begins with asking a better question. The question is not, what big number feels safe? The question is, how much annual spending do I actually need to support the life I want? And how much of that spending must come from my own portfolio? That is the bridge between fear and reality. Start with income. The median household income for people approaching retirement, roughly those between 55 and 64, is around $78,000 a year. Financial planners often use a simple replacement ratio and say that many retirees need about 80% of their pre-retirement income to maintain a similar lifestyle. That does not apply perfectly to everyone, but it gives us a reasonable starting point. 80% of $78,000 is about $62,400 per year. Now we can apply one of the most widely used retirement frameworks, the 4% rule. The basic idea is that if you withdraw 4% of your investment portfolio each year adjusted for inflation, the portfolio has historically had a high probability of lasting for about 30 years. No rule is perfect. All rules are simplifications. Future returns may be lower, inflation may be higher, healthcare may be more expensive. But rules like this are useful because they force us to quantify the problem instead of guessing. If you need $62,400 per year and you divide that by 4%, the number is $1.56 million at first. That seems to confirm the fear. It even comes in above the $1.46 million number. So someone might say, there it is, the scary number was right. But that conclusion is premature, because we have not included one of the largest sources of retirement income most Americans will have: Social Security. For many households, Social Security is not a side detail. It is one of the central variables in the equation. If you ignore it completely, you may produce a target that is technically conservative but practically misleading. The average Social Security benefit is around $22,000 per year. For some people, it will be lower. For higher earners, it can be significantly higher. But let us stay with the basic number because we are trying to build a general framework. If your spending target is $62,400 per year and Social Security provides about $22,000, then your portfolio does not need to generate $62,400. It needs to generate roughly $40,000. That changes everything. A portfolio that needs to generate $40,000 per year at a 4% withdrawal rate is about $1 million. Not $1.46 million, not $1.56 million, about $1 million. That is still a large number. I do not want to minimize it. But it is very different from the headline number. One feels impossible for many people. The other may still be difficult, but it becomes much more reachable when broken into years, monthly contributions, and compounding. Now, some people will immediately say, but Social Security may not be there when I retire. That is a fair concern. A good investor and a good planner should always stress test assumptions. You do not build a system by assuming everything will go perfectly. You build a system by asking what happens if something goes wrong. Social Security has funding problems, that is true. But saying Social Security has funding problems is not the same as saying it will disappear. Even in a severe scenario, payroll taxes would still fund a large portion of scheduled benefits. Some estimates suggest that even if the trust fund is depleted, the system could still pay around 3/4 or more of promised benefits from ongoing payroll tax revenue. So let us be conservative. Suppose Social Security benefits were reduced by around 20%. Instead of receiving about $22,000 per year, you receive roughly $17,800. Now your portfolio needs to cover about $44,600 per year. Using the 4% rule, that requires around $1.115 million, still below $1.46 million. This is why thinking in systems matters. When you only see the headline, you feel trapped. When you break the system down into variables, you see levers. One lever is income, another is spending, another is Social Security, another is time, another is the return you earn on your invested capital. And for many people, housing is the variable that changes the equation more than almost anything else. If you enter retirement with a mortgage payment, your retirement number may be much higher. If you enter retirement with a paid-off home, your required portfolio may be much lower. This is why I often say that boring decisions can be powerful. Paying down a mortgage does not look exciting. It does not feel like discovering the next great stock. But in retirement, the absence of a large fixed monthly payment can be one of the most valuable assets you own. The average mortgage payment in America is roughly $2,300 per month. That is around $27,600 per year. If you no longer need to generate that amount from your retirement portfolio, the entire retirement calculation changes. Imagine your annual expenses in retirement are not $62,400, but closer to $45,000, because the house is paid off and your lifestyle is more stable. If Social Security covers around $22,000, then your portfolio only needs to produce about $23,000 per year at a 4% withdrawal rate that requires about $575,000. That is not a poverty retirement. That is not rice and beans. That is a comfortable retirement for a household whose biggest fixed cost has been removed. This is why averages can be misleading. The average number does not know whether you own your home. It does not know whether you live in a low-cost or high-cost area. It does not know whether you want to travel internationally every month or garden in your backyard. It does not know whether you have a pension, rental income, part-time consulting income, or a spouse with a separate benefit. The average number does not know you. So the right process is not to worship the average. The right process is to build your own model. This is also where the math becomes more hopeful than most people expect. The compounding process is powerful when you begin early and continue consistently. It does not require perfection. It requires discipline and time. Suppose you are 30 years old and you invest $500 per month into a broad market index fund, earning an average of 10% per year over the long run, which is roughly in the range of the historical average often associated with the S&P 500. By age 65, that could become roughly $1.13 million. That is more than enough to reach the simplified $1 million target we calculated earlier. Not by gambling, not by day trading, not by finding secret investments, by contributing steadily and letting time do the work. If that same person increases the monthly investment to $750, the projected result rises to roughly $1.7 million by age 65, assuming the same long-run return that even exceeds the frightening $1.46 million headline number. The lesson is not that everyone will earn exactly 10%. Markets do not move in straight lines. There will be recessions, bear markets, inflation shocks, political shocks, and periods where returns disappoint. The lesson is that time and consistency are enormous forces when they are not interrupted by panic. Now suppose you are not 30, suppose you are 40. Many people hear compound interest examples and immediately feel discouraged because they started late. That is understandable, but it is not helpful. Let us use a different example. Suppose you are 40 years old. You earn around $85,000 per year, and you have already saved $50,000. Suppose your home will be paid off by your early 60s. Suppose you invest $600 per month into a broad market index fund for the next 25 years. At a 10% average annual return by age 65, that portfolio could grow to roughly $849,000. Now combine that with the spending equation. If your house is paid off and your annual expenses are around $42,000, and Social Security provides around $24,000 per year based on your earnings history, then your portfolio only needs to generate around $18,000 per year. 4% of $849,000 is about $34,000 per year. That gives you a margin of safety. The person who believed they needed $1.46 million might have looked at their current savings and said, "I will never get there." So why bother? That is the tragedy of fear-based numbers. They do not motivate people, they often defeat them. A math-based plan does something different. It says, here is where you are, here is what you need, here are the variables, here is the gap, here is the monthly action required to close it. That is how you make reality less frightening. There is another principle underneath all of this. Simplicity is often better than complexity. Many people think retirement investing requires cleverness. They think they need a complex portfolio, constant trading, or special insight. In my experience, most people do better when they build a simple system and follow it with consistency. A simple portfolio might include a broad market fund, a dividend-oriented fund, and a growth-oriented fund. The exact names matter less than the principle. The principle is to own diversified productive assets, keep costs low, avoid emotional trading, and allow compounding to operate over decades. If you complicate the system too much, you increase the chance that you will break it at the worst time. A simple system that you can follow is better than an impressive system that you abandon. This is true in investing and in life. The people who succeed financially are often not the ones who sound the smartest in a bull market. They are the ones who can keep doing the right things when markets fall. Headlines are scary, and everyone around them is making emotional decisions. That is why the retirement number you use matters so much. If the number is too vague and too frightening, it can lead you to despair. If the number is too optimistic, it can lead you to underprepare. The goal is not optimism or pessimism, the goal is accuracy. Accuracy begins with your spending. If you want to know what you actually need to retire, do not start with a national survey. Start with your own life. Look at what you spend now. Estimate what will go down in retirement. Maybe payroll taxes fall, maybe commuting costs fall, maybe the mortgage is gone, maybe work clothing and work lunches disappear, but also estimate what may go up. Healthcare may rise, travel may rise, insurance may rise, helping family may rise. Then subtract reliable income sources such as Social Security, pensions, annuities, or rental income if they apply. What remains is the amount your portfolio must support. Only then should you apply a withdrawal framework. That is the process. It is not exciting, but it works. And when you follow that process, you may discover that your real number is not the national headline. It may be lower, it may be higher, but at least it is yours. For some people, $1.46 million may not be enough. If you live in a very high-cost area, have large healthcare costs, want a high-spending retirement, or plan to support family members, your number could easily be higher. For others, $1 million may be more than enough, especially if housing is paid off and spending is controlled. For many households, a number between those extremes will be more realistic than the headline. What matters is not winning an argument about the perfect average. What matters is building a plan that fits reality. I want to be careful here because I do not want anyone to hear this and think the lesson is to save less. That is not the lesson. The lesson is to save with clarity. If you can save more, invest more, and build a larger margin of safety, that is excellent. A larger portfolio gives you more options, more resilience, and more freedom. But do not let an exaggerated fear number make you stop before you begin. The danger is not only that people save too little. The danger is that people see a number so large that they believe the game is already lost. When people believe the game is lost, they disengage, they stop contributing, they spend. Because saving feels pointless, they delay because the target feels unreal. They tell themselves they will start later, and later becomes never. That is how a bad number can damage real lives. A good number should lead to action. If your target is $1 million and you are 30. The action may be a steady monthly contribution. If you are 40, the action may be increasing your savings rate, keeping housing costs controlled, and staying consistent. If you are 50, the action may be working longer, reducing future fixed costs, increasing contributions, or considering part-time income in retirement. Every stage has levers. The key is to stop treating retirement as a mystery. It is not a mystery. It is a set of cash flows. Money comes in, money goes out. Assets compound, Social Security pays some amount. Spending requires some amount, the portfolio fills the gap. The smaller the gap, the lower the required portfolio. The larger the gap, the higher the required portfolio. That is the machine. Once you see the machine, the fear reduces, not because the problem disappears, but because you can interact with it. You can change your savings rate. You can change your spending, you can pay down debt, you can lower investment fees, you can delay retirement, you can move to a lower cost area. You can invest in a simple, diversified way, you can avoid panic selling, you can make decisions based on probabilities instead of feelings. That is how thoughtful people manage uncertainty. The $1.46 million headline is useful only if it forces you to ask the right question. It is harmful if it becomes a wall you stare at and never climb. Do not build your retirement around fear. Build it around principles. First, know your spending. Second, understand your income sources. Third, identify the gap your portfolio must cover. Fourth, use a reasonable withdrawal rule with a margin of safety. Fifth, invest consistently in productive assets. Sixth, keep the system simple enough that you can actually follow it. Seventh, remember that the goal is not to die with the largest possible number. The goal is to create a life where your resources support your freedom, your dignity, and your peace of mind. That is what retirement planning is really about. It is not about chasing a number someone else gave you. It is about knowing what enough means in your own life. When I look at these kinds of surveys, I do not dismiss them completely. They reveal something real. They reveal anxiety. They reveal inflation pressure. They reveal that many people do not trust the future. That information matters. But anxiety is not a plan. A survey is not a personal roadmap. A headline is not a retirement strategy. The real strategy is much quieter. You invest month after month. You avoid big mistakes. You keep your costs low. You let compounding work. You remove large fixed expenses before retirement if you can. You do not panic when the market falls. You do not assume Social Security is zero, but you also do not depend on it blindly. You use conservative assumptions and then act. This is the kind of thinking that keeps people from being controlled by the economic cycle. And it is also the kind of thinking that separates people who feel constantly behind from people who make steady progress even in an uncertain world. The world will always give you frightening numbers, debt numbers, inflation numbers, market crash numbers, retirement numbers. Your job is not to react emotionally to every number. Your job is to ask what the number means, how it was created, what variables it ignores, and what action it should lead to. That is how you stay grounded. So when someone tells you that you need $1.46 million to retire, do not panic and do not celebrate. Just do the work. Ask how much you will spend. Ask how much Social Security or other income will provide. Ask whether your home will be paid off. Ask what your portfolio must cover. Ask what monthly investment gets you there. Ask what margin of safety you want. Then build the system. The answer may be $575,000. It may be $1 million. It may be $1.46 million. It may be more. But whatever it is, it should come from your math, not someone else's fear. That is the difference between being controlled by a number and using a number as a tool. And in retirement planning, as in markets and in life, the person who understands the machine has a very different outcome from the person who only reacts to the noise.